Ryan, thanks very much for joining us. We thought we'd do a quick webcast for you to go through our views in terms of what 2019 might have in store for our energy investors. But before we do that, I just wanted to quickly summarize 2018, which turned out to be another tumultuous year for energy investors. It feels like we've been stuck in a rut for a while now. 2018 was especially frustrating for us because coming into the year, we and many were quite optimistic on the energy space. Oil was at $60 at the time, and we had strong views that oil was going to go to $70 as the trend of inventory drawdowns continued. The outlook for the global economy remained very strong, and we believed that U.S. producers would remain disciplined in not outspending their cash flows in a robust oil price environment. And what we show on slide 8 of our presentation is that the critical aspect of why we've been bullish on oil for a couple of years now is that the inventory glut that was created in 2016 was quickly coming to an end. We viewed that the oil market was going to be going into a multi-year deficit. And as a reminder, there's a very strong inverse correlation between inventories and the oil price. We look at inventories as kind of our real-time proxy for whether the market is under or oversupplied. So it shouldn't be a stretch to imagine that as inventories fall, typically the oil price does go up. Further fuel for our bullish view was in the beginning of the summertime, and that was the Trump administration came down ultra aggressively on Iran. Trump announced that they were withdrawing from the joint nuclear agreement, and most importantly would be imposing sanctions on Iran, specifically on their export of crude oil. And Iran being a fairly major exporter of crude oil, this was viewed as wildly positive for the oil price because we were in a market that was still undersupplied. U.S. demand growth was growing, but at moderate rates. Demand growth was growing by about 1.7, 1.8 million barrels per day. So this made us ultra bullish, and we issued several commentaries saying that given our view that the world would be unable to replace Iranian export losses, that there was a very real likelihood that at some point in 2019, the oil price could eclipse $100 per barrel. We were not alone. Many others were joining that view. Oil had rallied, I would say, to about the high 60s on the perspective that the market was tightening. And then once this storyline really started to enter into the market, oil took off and hit a high of around $75 in late September. What we did not know at the time was that while Trump was coming down ultra hard on Iran, they had struck a temporarily secretive agreement with Saudi Arabia, Mohammed bin Salman, when he visited the U.S., and then in subsequent conversations, that in exchange for Trump being ultra aggressive on Saudi Arabia's archenemy, that Saudi in return would increase oil production. We started to see that around April, May, where production started to surge from the low 10 millions to ultimately a high of 11 million barrels per day in October. They were not alone. A few other countries as well, the UAE and Russia, joined that. So the OPEC Plus added 1.8 million barrels per day. And as Saudi was increasing production, we saw that, and we saw inventory trajectories start to moderate. But we weren't concerned at the time because we viewed it as temporary, because what we knew was that Iranian exports would be coming to a standstill, highly likely to be below 1 million barrels per day. So while we saw inventory start to increase again, we thought it was just going to be a waiting game. At the same time, U.S. production was increasing faster than expectations. That trend has continued. A large part of that has been the Gulf of Mexico. So when you see growth rates of like 1.8, 1.9 million barrels per day last year for the U.S., it's not all just U.S. shale. U.S. shale is going to be up about 1.4 to 1.5. That's the repeatable production growth. Offshore projects are not repeatable, although they did catch us and others off guard. So while we had this narrative that with OPEC increasing production, don't worry, it's just a mismatch in timing. We've got Iranian exports quickly coming to an end. There was also this narrative of Donald Trump via Twitter that we show on slide 14, where he was just incessantly attacking OPEC. And so that started in April. It was heading into the midterm elections, very strong inverse correlation between the gasoline price and presidential approval rates. So you see Trump, like even in the summertime, my favorite one was at the bottom left, where Trump felt that he had needed to educate the king of Saudi Arabia on the oil markets and why Saudi needed to increase production by 2 million barrels per day, which was physically impossible. But it just shows you the fervor that oil, the discussion or Donald Trump's focus on oil reached in 2018. So lo and behold, why did oil collapse from 75 down to the low 40s? It was that in November, the Trump administration dropped a bomb on the energy markets, and despite them saying that they would be ultra hawkish, their intent was to drive Iranian exports to zero, it became obvious that Trump was very sensitive to the oil price. They were not ignorant to the impact that they were going to have. And so what did they do? They issued waivers to basically every single country that was already importing Iranian oil, admittedly at reduced rates, but not nearly as bullish as the market had viewed. So here we had OPEC, mainly Saudi Arabia, increased production in anticipation of very strong sanctions. And lo and behold, they were lied to. They were betrayed. And we get that from consultants who've spoken to emissaries within the Saudi government. They feel completely betrayed by the Trump government. And so what happened? We saw oil crash by 47% due to, again, a temporary oversupply. We saw liquidation, the net spec length in oil fall by 70%. I believe that is the fastest pace in history. And how crazy were November and December in a historical perspective? What we've seen is the increased financialization of oil. Oil is effectively acting as a levered proxy to the stock market, to people's view of the global economy. And so we've seen the correlation between oil and the S&P 500 really tighten. And on slide 18, we show it on a slide courtesy of Bernstein, some of the crazy days that we had in November and December where literally unknown news. Like you wake up at 5:30, you check Twitter, you check headlines, there's nothing really going on, and oil falls 8% in a day. And so we show how extraneous those moves were relative to the normal distribution of oil, daily oil prices going back to 1983, and you see just how insane November and December was. And that corroborates our view that the implosion in the oil price had little to do with fundamentals. You could explain, let's say $15, oil falls from 75 to 60. You cannot explain it falling into the low 40s based upon a temporary loosening of the market. And we felt confident that OPEC would realize their error, that they were lied to, betrayed to, and they would take it upon themselves to fix the issue. And lo and behold, in December, OPEC strikes a deal to cut production by 1.2 million barrels per day. We now know with another month passing that this is actually going to be eclipsed. Saudi Arabia announced that they would be overachievers on their goals, so they would be cutting production below their 10.2 million, and they're hoping to average 10.1 million this month in February, and we've seen other producers cut back. The drop, we just got the stats this morning in the month of January. It was the largest fall in OPEC production in 2 years' time. So Saudi, OPEC, they are committed to ensuring that they restore the imbalance that they created due to being lied to. And on slide 20, we have the market entering into a deficit relative to the 5-year average about next month, give or take a couple of months. So in the short term, what are the governors of the oil price? It really comes down to a few key things. One is the trajectory of U.S. production. 2 is going to be OPEC compliance to their deal. And then 3 is going to be demand concerns, and that will be dictated by stats that come out. Jobs data this morning out of the U.S. was like almost double consensus to the positive. And it's going to come down to whether there's an easement in tensions between the U.S. and China. But when it comes to the U.S., so a key distinction that I picked up at the first major energy conference of the year was over the past 2 years, U.S. shale companies have talked about discipline. They talked about not pursuing growth for growth's sake. But a key change this time in 2019 is that U.S. companies are now going to be budgeting a very modest oil price, I think $50 on average. And critically, this year, if oil price exceeds that level, and the strip price right now is 55, any incremental free cash flow or cash flows beyond that level will not go into the ground. They will go into either deleveraging or most likely towards shareholder returns. So that's like share buybacks and dividends. And the reason for that is that if you think you're frustrated with the performance of energy equities, imagine being a CEO where you just basically had a record year last year from an operational perspective and your stock fell 20, 30, 40%. And so they recognize the need, the critical need to get generalist money back into the energy sector. They need to not just compete with themselves, but they have to compete with other industries from a rate of return perspective. And so you do that by underspending your cash flow, by maximizing the economic return of every single well you drill, and by returning cash to your shareholders in the form of dividends and buybacks. So US shale basically stays flat at 50 and it grows at about 60. And so we believe that, given our view of demand growth, and we'll touch on that in a second, that we need $60 oil, effectively WTI. So that's about a $65 Brent price for U.S. Production growth. We think U.S. will grow by about 1.2 million barrels per day this year. So that's a strong deceleration from last year. Secondly, we think that OPEC is going to show strong resolve to get a meaningfully higher oil price simply because they must. Their survival, literally, depends on a meaningfully higher oil price. Saudi Arabia needs a Brent price of $78 per barrel. So that's about 72, 73 WTI. And so as they did their best to cut back on social spending, they've had to reintroduce a lot of expenditures yet again with a young unemployed population to cement their social contract to ensure stability within the kingdom. And while military spending is slightly down, they themselves are budgeting $78 Brent to be able to not further draw down their foreign exchange reserves. So we've spoke last year about the four elements to our multi-year bull market. We still believe that we're in that. Different variables have changed, some for the better, some for the worse. But generally speaking, we view the market as remaining tight. We believe that OPEC, generally speaking, has basically no spare capacity outside of the 1.2, 1.3 million that they've been shutting in as a result of the recent deal. So total spare capacity within OPEC, even accounting for that, represents about 1 year of demand growth. We still view the lack of investment over prior years within OPEC to be a major determinant of lack of meaningful production growth in the foreseeable future. The same is true in non-OPEC, non-US countries, where we've had a massive implosion in investment, and as a result, non-OPEC, non-US production is going to basically stagnate beginning next year in 2020 and beyond. And so the call really remains on the US to be the marginal swing producer, and we know that marginal swing producer requires $60 in order to grow. The biggest concern that people have now on slide 28 is demand. We've seen a strong deceleration in the global economy, most especially within China. You can debate whether that's as a result of trade sanctions or just coming off of very, very high growth levels to like more reasonable growth levels. The IMF cut their growth forecast this year from 3.7% to 3.5%, but forget the cut. If you were just told we're going to grow by 3.5% globally this year, most people would say that that's an extraordinarily strong number. That still portends very meaningful demand growth for oil, and yet that's a primary concern. And so the key point we would say is we've yet to actually see it show up in the data. U.S. demand continues to be very strong, record miles driven. Even within China, where most people are most concerned, production or demand, was up about 600,000 barrels per day in the month of December. Very, very strong number. So despite fears, as we always have with us, they've not shown up in the data. So just summarizing our macro call, and then we'll get into positioning. 2018 was a horrible year for the oil price. There was just a further disconnect between fundamentals and reality. The financial market for oil is 30 times the size of the physical, and it really trumped in November and December, where as a result of Saudi being misled and bringing on production which they should not have done and having to correct that subsequently in December, the oil price crashed by 47%. And the strong rally that we've had from oil going from 42 on Christmas Eve to $54 today, I can't explain that increase either fundamentally. It tells you that oil never should have sold off to the extent that it did. And so there's a rebuilding phase that we're now in to restore people's confidence in oil fundamentals, and that's just simply going to take time. Any development on the economic side, so we've had now a cessation of an increase in interest rates. The final piece of the puzzle is hopefully a trade deal or supposed trade deal between China and the United States. So our view remains, we think that oil will trade to $60 by the end of this year. We think it's going to happen sooner rather than later. And with that as a backdrop, where do we have your and our capital exposed? We essentially are roughly about 50-50 split today between Canada and the US. And the two major areas that we are most excited about is one, Canadian heavy oil, and two, US light oil. And that predominantly is in the Permian. I'll get into the reasons why. So in terms of US light oil, generally speaking, Canadian light oil companies are not competitive. Typically, inventory depth is less than half of what we can get in the Permian. There is no pipeline takeaway capacity issues in the Permian. In fact, it's going to be overpiped, which is very good for the producers. As the U.S. increases their export capacity, it's likely that U.S. Permian is going to be getting more of a Brent type price rather than a WTI type price. And balance sheets are strong. So we're basically getting better rock, more inventory depth, the ability to grow at twice the growth rate spending within cash flow for only a slight premium in valuation. So it's kind of a no-brainer to us to have capital devoted there. We're invested in names like a Diamondback, biggest position in the fund. They're growing by over 20%, spending less than their cash flow and still generating free cash flow. We're paying like 4.6 times the value of its enterprise value. This is a $20 billion company growing 20% a year for the foreseeable future. And so we're pretty excited about names like that. Secondly, we're really excited about Canadian heavy oil. And despite all of the headwinds that we've very extensively written about, we're really bullish on heavy oil differentials. And we're bullish not just because of the Alberta action that occurred in December. For anybody who follows us on Twitter, we had called for that action. We publicly supported it. We predicted it. We were positioned for it. We believe that we're now in a new era of lower differentials because Canada's added a tremendous amount of capacity on rail. Rail capacity has almost doubled in the past year. We see that growing even further from the mid 300s to about 450,000 barrels a day to end the year. We also see progress on some pipeline initiatives. We have Line 3 hopefully coming on later this year. That's adding 370,000 barrels per day of capacity. Once that comes on, then the pipeline owners have initiatives to optimize the flow line. So total export capacity out of Canada this year is actually going to grow by 600,000 barrels per day. And we've seen differentials fall from the high of 50 to now sub 10. And, while sub 10 might be temporarily a little tight, even if we get back to pipeline economics, we think we'll do better than that at $20. In a $60 WTI world with a 1.31 exchange rate and $20 USD differentials, that's a very, very profitable environment for Canadian heavy oil names. And we're effectively getting the attributes of Permian that we like, which is inventory depth, ability to grow, ability to access international pricing. We get all of those aspects, and yet we get them in Canada, an area that is most profoundly out of favor, where very few people are looking. So those are the two areas that we have capital devoted. We see very meaningful upside in Canadian heavy oil names, a name like a Baytex, a name like a MEG, where like MEG, a $10 increase in oil price increases their cash flow by about 70 or 80%. Like it's very, very, very meaningful. And so we're pretty excited about those two areas. So just to conclude, we know 2018 was a horrific year. We cannot explain the drop in oil using fundamentals. And those views are kind of corroborated with the extent of the rally that we've had so far this year. We now have holdings where at $60 oil, they're trading at less than half of their historical multiples. And I could have said that last year, and here we are again. They're trading at above 20% free cash flow yields, some names in excess of 30% free cash flow yields. So if investors globally want to continue to shun this space and not recognize how inexpensive and mispriced these equities are, then what we have seen and will continue to see are companies step up and buy back their shares aggressively. We saw some companies in the US buy back 20% of their shares outstanding last year. And so if you're trading at a 30% free cash flow yield, you can effectively privatize within 3 years, just from the incremental free cash flow above which you need to keep production flat. So that's our backstop. That is the curative and the answer to anybody that asks, well, what happens if people just continue not to avoid this space? It's the free cash flow that I think is going to allow companies to be the recipients of multiple expansions. So once again, thank you for your support, your interest in the space, your confidence in us. It was one heck of an incredible year to navigate through last year. We thought we did a very good job calling the fundamentals of oil that mattered up until like the fall time, and then things just completely derailed. So we're in a rebuilding mode today. We're excited about the names that we own. We're excited about the upside. We're just waiting to hit that inflection point in sentiment when we're not the only ones in the world that sees what we see. So thanks for your time today.